What's up, guys? This is video 2, week 2, learning from a beginner. We're going to be going over the long term today. Main focus on ETFs and dividends, why they're important, and why the long term itself is important in general. Last week we talked about, or I talked about, having that hunger mindset, right? You got to change that mindset, and also having patience with it. But the overall theme I was really trying to get at was having a discipline, right? Having that discipline to spend an hour or two a day either looking up videos about the stock market or even in the brokerage account, diving into a brokerage account and just, spending an hour, pushing buttons, seeing what this does, setting up a little watch list for yourself, things like that. But also how this discipline will really help you with the long term, right? Because nobody taught me about the long term, and oh man, I wish I would have started it when I first, as soon as possible, as soon as I could have. But the reason why the long term really struck me the way it did in the stock market, right, having a long term in the stock market, is inflation year to year and how little a savings account from almost any bank nationally, how little they give you. I'm with Bank of America, for example. A lot of people are with Bank of America, Chase, you name it. Their average savings account is 0.01% annually. I looked this up, and nationally, uh, is still 0.06 on average. Some people have some amazing bank accounts that actually give a percentage, but on average, many millions of Americans don't. They have a basic savings plan, which is 0.01% return annually. So that opened my eyes, right? When I found out that inflation, and I'll put up some pictures here, inflation from 1956 to 2020, annual inflation average was 3.6%. Inflation, right? So then I looked up, okay, what about something a little closer, more current? I went ahead and did a 2010 to 2020 comparison on the inflation calculator, and it still gave me an annual inflation average of 1.6%. So if you have thousands of dollars in your savings account right now, just sitting there, not doing anything, year after year, your money is worth less, right? And when you look at the stock market, on average, you get a 7 to 10% return, depending on which companies you're invested in. But if you just go into the SPY, which is an ET, and I'll get into this in a second and why they're important, um, the average return is what, 10% a year. So millions of people don't know this, but the main point of it was that inflation. That's what got me. I have thousands in my savings account, and it was just sitting there not doing nothing, actually losing money year after year. And I thought I was doing something with it. So that's one thing I wanna look towards when we're talking today. But okay, so something's that I wish somebody would have taught me when I first joined the stock market. So when I'm joining the stock market, all I saw was all types of companies like this right here on your left. You could see all types of companies here. There's so many. There's so many different companies, stocks, ETFs, indexes. There's so many to choose from. It could be overwhelming. So what I would like to pass on to you is pick 10 to 15 solid companies that you look at that interest you, whether it be tech, uh, oil and gas, whatever, and save them to your watch list. So you could do this on Robinhood. I'm using Webull right here as an example. You press the follow and then add them to your watch list. The ones that you want. So right here, the reason why I like Webull, Robinhood, a lot of other ones do this too, but I could set them up here so you see all my watch lists. And the ones that I have that are, 10 to 15, I call my close eye stocks. I have them all right here. Tesla, Netflix, Square, AMD. This really helps you kind of just focus in on these companies and see how they fluctuate. So for example, I'm looking at AT&T for a minute, great dividend stock, but this I could see how it fluctuates. What's the volatility? Let's go to year to date, and then I could make certain plans from this. So on my close eye stocks, I either look at it to go in for the long term to buy, equity in these companies, or to do option trading. But that we're going to go into in a second. But this at least gives you a nice little footwork of, okay, I know these companies now. Uber, Netflix, Snapchat. I follow the news down here. I could see a little bit more. You get more comfortable with these companies. And that's something that's really, really important, because if you just dive into them without knowing much about them, you could be losing a lot of money, right? Or you could be missing opportunities. So, since we're talking about the long term, I think this is a great way to start. But one thing that's necessary for long term are ETFs, right? This is, or dividend paying stocks, which is what we're going to be focusing on. An ETF is a index. So let's say you're looking at tech, for example. We're going to do an example about this right now too. Let me actually pull it up. Let's say we're looking at tech. Let's go to Market Watch. This is a great resource, by the way. Check out Market Watch. It's free, and you can check out all types of stocks super easy. So let's check out XLK. So this is a technology sector ETF, all right? And on Market Watch, we could see that it's at 117.05. The market's open right now, so it's going to be fluctuating. And then right here, we can go scroll a little down. We can see the overview. On certain other brokerages like Robinhood or Webull, it might say quote. This would be the quote of the stock or company. So it's pretty self-explanatory. I'm going to run through them real quick. It opened at 117.09. The day range on some other brokerages, it might say the low and the high of the day. 52-week range, it might say 52-week low, 52-week high. We can see the growth of this company in just 1 year. Doesn't have a market cap. It's an ETF. Assets, this is all pretty self-explanatory. One thing that people don't tell you about ETFs is that you have to pay for them, right? This is the expense ratio. When I was first learning about it, everybody was saying, "Hey, dive into these ETFs. It's basically a one-stop shop for all these type of companies. Why buy individually?" But nobody ever explained to me that you have to pay for these ETFs, right? You have to pay for them because these are managed accounts. So this example here is a passive ETF. There's a passive and an actively managed ETFs. The passive ones usually cost less. So this is less than 1%. This is very much doable, right? It's not that expensive. This one is also a special one, this ETF, simply because they also pay out a dividend. 1% of whatever you're investing in, or 28 cents per share, right? Then we have the X dividend rate. If, for example, you wanted to get in, own this company and then qualify for their next dividend payment, you would have to buy equity in this company on June 21st, not the 22nd. If you do it on the 22nd or later, you won't qualify for the upcoming dividend payment. You'll qualify for the one after that one. So that's one thing to keep in mind. This is also important to know for events. So when you're looking at stocks, that 10 to 15 list that you have, keep an eye on events. So events could be dividend payments. Events could be earnings reports. Events could be they're launching a new product, a new service, or simply news. You could always check news, and that could be, that could fluctuate this current company or stock or whatever it is. Then you have the average volume. That's pretty high. It's pretty high volume. But the reason why I like this MarketWatch website is because it also shows me what these ETFs have in them, right? So this one's supposed to have a whole bunch of companies in one that I can invest in. So right here in holdings, you could see at the top the percent of total assets, the year to date on them, the symbols, and the company name. If I scroll all the way at the bottom, I could see that 23% of this portfolio is Apple. 20% is Microsoft, 4% is Visa, and if I check the names here, MasterCard, Nvidia, PayPal, Adobe, Intel, these are very well-known companies, very safe companies, some could say, right? Especially in the tech industry. These companies aren't going away anytime soon. And right here, you get to just dive in and buy them all. You also could see here, financials, industry, technology, 80% tech. Excuse me. But this is a great resource overall. Now I'm going to put some links down below to kind of some articles really explaining the differences of the ETFs, passive and active. I'm going to give a brief summary here, but right here you could see this ETF XOK is a passive ETF. It was 0.13%, right? So the difference really between a passive and an active one, besides the active one costing a little more, is that the passive, I think only 4 times a year do they sell off or add more companies to this index potentially. So 4 times a year they could see, let's say one of these companies is doing terrible. They could either cut their losses and sell, or if, let's say a company is doing very, very well, they could also sell for a profit, which is what people think happened recently, where in September they had a huge sell-off. Now it's kind of coming back up. Usually people, or these indexes, buy when it's low to kind of, get that return again. They do that 4 times a year on average. And there's hundreds of these types of ETFs, passives, right? But with the active, let's actually take a look at one. Let's take a look at ARK. This is a pretty, wow, pretty good ETF. Okay, this one's at 91. It's definitely going up. So right here you can see where it opened, the day range. This is all great. The expense ratio, 0.75% compared to 0.13%. You could see the difference on this one. But the turnover, so the other one, the other ETF was a 6% turnover for the year. This one is an 80% turnover for this year. A ridiculous amount of growth for this passive, actively managed ETF. 80%, that's huge. That is huge. Usually you would see exactly what we saw on the other one, a 6%, maybe a 9% for the year. They usually do metrics every 5 to 10 years on ETFs. But this one, in just 1 year, 80% return. Ridiculous. And I'll explain why in a second. Dividends. So this one, they don't pay a dividend anymore, but they used to. A lot of companies are doing this because of COVID. They either were paying a dividend and stopped for a sec. That's another thing about dividends you have to be careful of. Dividends are basically the company pays you for owning equity in their company. Simple as that. You get a piece of the pie. That's it. So a lot of companies stopped doing dividend payments because of COVID. But right here you can see they used to pay a small dividend. So if you used to, but they're also way cheaper, or they were way cheaper compared to the other ETF. So you only get 19 cents per share, right? Right now they're not offering it, but they could potentially offer it in the future. It's a good thing to keep an eye on. So let's see what this ETF is actually holding, though. What makes it so much better than the 6% other ETF that we saw? Right here we can see they have 9% of Tesla, 8% of Square, Roku, Zillow Group. They have a lot of companies I haven't heard of, though. A lot of companies I haven't heard of, and you can see right here the year to date, they don't have as much red as the other ETF did. Why is that? It's because with these actively managed ETFs, they have a team of people that look for different companies and see which ones have potential, right? So they could also sell off losing stocks quicker. They could buy into companies when they're first starting out, which gives us that growth that we see with Tesla and Square. These both of these companies had huge growth this year. Huge. I mean, look at Tesla. It's ridiculous. Which is why it had an 80% return with just this pat. And it's not even that expensive, right? It used to be way less. Let's take a look at it here. We get to see the chart. I actually bought some of this on the run down at 85. I got 5 shares of this one, and I already have a return. You can see right here, I have 29 bucks return on it just from buying those 5, right? But you can see on April or even COVID, right? This is COVID right here. They were at $34. This amount of growth is insane. And this isn't like a stock where it might just go all the way up and then have a huge drop, because this one's actively managed, so they could sell off losing companies or shares, or sell off for profit and then buy again with that profit. So these type of companies, you definitely keep an eye. Definitely use this resource, but do your own research with ETFs, right? Because they can be complicated. There's so many to choose from. But the real question is, which one do you get, right? A passive or an active ETF, or do you just buy the stock itself if you see one's doing good? The answer is all of them. Why not? Why not buy into this ETF? That's it might cost a little more, but its returns are insane. This is a well-managed ETF right here. Also with the passive, why not, if I have money in my savings, right, not doing anything as we talked about, and I put it into a passive ETF where there's less risk, it costs less, and then it still has steady growth of up to even 6%, right? Way better than a 0.01% that many people are currently getting now by just having your money sit in the bank. But as I said, I'm going to be leaving the links in the description. It's definitely worth a read. Spend 5 minutes of your day, take a look at it. Has a lot of information about these ETFs and the taxes that you have to do on them. Some of them have less taxes depending on how long you hold it, how you play it. That's another thing to look at, just so your profits that you take back, you know how much you're going to get taxed from, because you got to pay Uncle Sam. Another thing we're going to go over real quick is dividend stocks. I'm going to add another link to that. But some good dividend stocks would be, I don't have a watch list for those, but I do have some paying a dividend. For example, let me scroll down here. McDonald's. McDonald's pays a dividend, right? We're looking at the quote here. Dividend yield 2%. So let's say you don't want to do an ETF, right? Which I don't see why you wouldn't. But let's say you don't want to do ETFs. You'd rather invest in the companies themselves. McDonald's would be a good one. AT&T would be a good one. Look at the div percent, and this is how much you're going to be getting back a year from what you put in. But here's the things about dividends. Dividends, it's not set in stone. This is something to be careful about. A lot of people were shocked when COVID hit and a lot of companies cut off their dividends without warning. But they could do that. They don't have to pay a dividend, like they don't owe you anything. They don't have to pay anything out if they don't want to. But it does make it more, appeasing to people that if companies do pay a dividend, they're more safer. People would invest in them more. But McDonald's, I believe, is still paying out their dividend. AT&T as well is still paying out their dividend. There's a bunch of other companies that are doing it still. But AT&T, for an example, would div percent 7% yield on this one. Ridiculous. So I would definitely look at these dividend payment. You can find it in the quote, right? Find it in the overview of the stock that you're looking at. Some of them don't pay, some of them do. Be careful with the ones that pay over 10% dividend yield. Look into them closely. A lot of times they do not pay that out. A lot of times their profits do not reflect that they could pay out these dividends, which can be a red flag. It's an indicator of being like, okay, I got to take a look at this company because something's not right. There have been cases where, yeah, they do pay out a high dividend yield, but the company itself isn't in the right framework to be paying out such high dividend yields. And it doesn't it's just a red flag. Something, a bell should go off in your head to be like, hey, I got to pay attention more to this company that I'm investing my money in, right? I say a safe spot would be 1 to even 8%, 9% dividend yield, right? That's probably a safer bet that companies will most likely be able to pay out in that percentile. But of course, do your own research, right? Nothing is a recommendation. If you have any questions, let me know. I know I breezed through this, didn't want to make it too long, but that's the gist of ETFs and dividend stocks, right? I didn't list too much. I'm gonna post some in the comments. Let me know what you guys think.